Did you know that over 4.7 million UK homes could face higher council tax bills in 2026 without even changing hands? That's right. A sweeping property tax shakeup is coming, and for many homeowners, it won't be pretty. Whether you're living in your forever home, renting out a flat, or planning to buy, the new rules could cost you thousands more per year, unless you act now. The government is quietly rolling out 10 major tax changes that affect everything from how you sell your property to what happens when you leave it to your children, or even if you just own a second home. And no, this isn't just for landlords or investors. Everyday homeowners are caught in the crossfire. So what's changing exactly? And more importantly, how can you protect your hard-earned money? Stay with me, because what you don't know about 2026 could cost you big. Number 1. Council tax revaluation. After nearly 3 decades, the UK government is finally moving forward with a nationwide council tax revaluation, starting in 2026. This means your home could be placed into a completely new tax band based on its updated market value, not what it was worth back in the early 1990s. While this may sound like an overdue update, the reality is more concerning. Millions of homeowners across England and Wales could see a sudden spike in their annual council tax bill, even if their property hasn't changed a bit. What makes this even more controversial is that property values have surged dramatically in many regions, especially since the pandemic. That means even modest homes could end up in higher tax bands, potentially paying hundreds more each year. And here's the catch: you can't opt out. Once your property is reassessed, you'll have to pay the new rate unless you successfully challenge the banding, which can be a complex process in itself. So what can you do now to prepare? Start by checking your current council tax band through the Valuation Office Agency, VOA. If you think it's already too high, gather evidence, such as recent sale prices of similar properties in your area, and consider filing a rebanding request before the revaluation kicks in. Staying informed is key, because once these changes go live, your window to dispute them without penalty may be limited. This isn't just a local issue. It's a national overhaul that could quietly impact your monthly budget for years to come. Number 2. Capital gains tax threshold reduction. From April 2026, the UK government is tightening the screws once again on property owners by reducing the capital gains tax, CGT, allowance even further. This is the amount of profit you can make when selling a second property, like a buy-to-let or holiday home, before you start paying tax. In previous years, the CGT allowance has already been slashed from over £12,000 to just £3,000. Now, with further reductions confirmed, selling property will become significantly more expensive for anyone who's not living in the home full-time. This change will hit small landlords and accidental property owners the hardest. For example, if you inherited a second home or decided to rent out a property after moving elsewhere, you'll now face a much larger tax bill when it comes time to sell. And it's not just about the tax itself, it's about timing. The longer you wait to sell after April 2026, the more your potential profit shrinks, as more of it gets eaten up by HMRC. To avoid a financial sting, now is the time to act. If you're considering selling a property, speak to a financial advisor or tax planner before the new rules take effect. Explore available reliefs like private residence relief or lettings relief, which could significantly reduce your tax liability if you qualify. You may also want to consider selling before April 2026 if the numbers work in your favor. The bottom line is this: the window to make tax-efficient property sales is rapidly closing, and ignoring these changes could cost you thousands. Understanding how CGT works now is crucial to keeping more of your hard-earned money later. Number 3. Stamp duty holiday is fully gone. If you are hoping for another stamp duty break like the one seen during the pandemic, it's time to adjust your expectations. As of 2026, the stamp duty land tax, SDLT, system has fully returned to pre-pandemic levels, and there are no new reliefs or discounts planned. The temporary stamp duty holiday introduced in 2020 saved buyers up to £15,000 and helped stimulate the market during uncertain times. But those days are now firmly behind us, and for most buyers, higher upfront costs are back on the table. What does this mean for you? Whether you're buying your first home, moving up the property ladder, or investing in a rental, you'll need to budget more for stamp duty than you might have in recent years. For properties over £250,000, the tax quickly becomes a significant chunk of the total cost. And for second homes or buy-to-let purchases, there's still the additional 3% surcharge, which makes buying an extra property even more expensive. Many potential buyers are getting caught off guard by these renewed rates, stretching their finances to the limit or missing out on properties altogether. To avoid unexpected expenses, always factor in stamp duty early in the buying process. Use the HMRC online calculator to estimate your liability based on current rates. If you're buying with a partner or considering a transfer of equity, seek legal advice, as there might be ways to structure the purchase more efficiently. And remember, while some first-time buyer discounts still exist, they are far more limited than during the holiday period. In short, buying property in 2026 means playing by the full rules again, and failing to plan could leave you paying more than you bargained for. Number 4. Mortgage interest relief ends for holiday lets. One of the biggest shocks coming in 2026 is the removal of full mortgage interest relief for furnished holiday lets. For years, holiday let owners enjoyed generous tax treatment, allowing them to deduct their entire mortgage interest from rental income before paying tax. That advantage is now disappearing. From 2026, holiday lets will be treated much more like standard rental properties, meaning interest relief will be restricted and less generous, directly increasing taxable profits. This change is especially painful for small and medium-sized owners who rely on holiday lets for supplemental income. Many owners operate on tight margins, with high mortgage costs, seasonal income, and rising maintenance expenses. Once full relief is removed, profits on paper may look higher, even if real cash flow hasn't changed at all. That can push owners into higher tax brackets, resulting in unexpectedly large tax bills. In some cases, properties that once made sense financially may suddenly feel like a burden rather than an asset. So what can holiday let owners do? The first step is to run the numbers early. Speak to an accountant to understand how your tax position will change under the new rules. Some owners may consider switching to long-term rentals, while others may explore incorporating their property business, which could allow mortgage interest to be treated differently. There's also the option of reducing debt or adjusting pricing strategies to protect cash flow. The key point is this: doing nothing is the most expensive option. The tax rules are changing whether you're ready or not, and planning ahead could mean the difference between a profitable property and one that quietly drains your income year after year. Number 5. Higher council tax for second homes. From April 2026, many local councils in England will gain new powers to double the council tax on second homes, and some areas have already confirmed plans to implement it. This move is part of a wider effort to tackle housing shortages and reduce the number of homes sitting empty in areas with high demand. While it may sound like a policy targeting wealthy investors, the reality is that it affects anyone who owns a second property, including families with inherited homes or those with a modest holiday retreat they visit a few times a year. The financial impact is significant. A property currently paying £2,000 a year in council tax could soon be charged £4,000 annually, even if it's barely used. For some homeowners, this change could force a tough decision: sell the property, rent it out full-time, or absorb the cost. And unlike other taxes, this charge is applied regardless of income. So even retirees or lower-income homeowners won't be spared if they fall into this category. It's a blanket policy with broad implications, especially for those not actively using or monetizing their second home. To prepare, check your local council's position. Some have already voted to bring in the maximum surcharge, while others are still reviewing their approach. If your second home is mostly unoccupied, consider letting it out to qualify for business rates instead, which in some cases could reduce your overall tax burden. Alternatively, using the home more regularly or making it your main residence might offer some protection. What's clear is that the old model of keeping a second home just in case or for occasional use is becoming more expensive, and homeowners will need to make smarter, strategic decisions to avoid paying the price. Before we dive into the next big change, let us know in the comments, which of these tax updates surprised you the most so far? We put a huge amount of research into making these videos simple and useful, so if you're finding value here, hit that subscribe button. It's just one click, and it really helps us keep going. Number 6. Landlord licensing expansion. In 2026, more UK councils are expanding landlord licensing schemes, making it a legal requirement for landlords to register and obtain a license before renting out properties. While selective licensing isn't new, the number of areas enforcing it is growing rapidly, and failing to comply could mean hefty fines, rent repayment orders, or even prosecution. These schemes are being rolled out to improve rental standards and crack down on rogue landlords, but many responsible landlords are getting caught in the net, often without even knowing they need a license. What's especially challenging is that licensing rules vary from council to council. A property that doesn't need a license in one borough may require it just a few streets away. And with councils now given more flexibility to expand these schemes, even landlords with a single property must stay alert. Licenses usually come with fees, paperwork, inspections, and conditions about property standards or tenant management. It's no longer just about collecting rent. Landlords are expected to run their properties more like regulated businesses. So what can landlords do? First, check your local authority's housing website to see if licensing applies in your area or if new rules are being introduced soon. Don't assume anything, even if you've been renting out the same property for years. If a license is required, apply early to avoid delays and ensure your property meets the conditions. Keeping records of safety checks, repairs, and tenant communications will also help if your license is reviewed or challenged. As the private rental sector becomes more tightly regulated, landlords must become more proactive. Ignoring these changes isn't just risky. It can be extremely expensive. In 2026, staying compliant will no longer be optional. It's the new cost of doing business as a landlord in the UK. Number 7. Green home incentives are changing. The push for greener homes in the UK has led to various government-backed incentives in recent years, but in 2026, several of these financial support schemes are being revised, scaled back, or phased out altogether. One major example is the Boiler Upgrade Scheme, which previously offered grants to help homeowners switch to low-carbon heating systems like heat pumps. As funding windows close and new environmental policies are introduced, many homeowners may find that upgrading to energy-efficient systems becomes more expensive without that government support. This shift is part of a broader strategy to place more of the financial responsibility on property owners themselves. In future, if you want to replace your gas boiler, improve insulation, or install solar panels, you might not have access to the same grants or rebates previously offered. This can be a serious barrier for households looking to cut their energy bills or reduce their carbon footprint, especially when upfront costs for green tech can run into the thousands. What's more, minimum energy efficiency standards are likely to tighten, meaning landlords and sellers could be required to make costly improvements before renting or selling a property. So, what can you do before these changes hit? If you're already considering energy upgrades, act now. Check what grants and incentives are still available through official government sources or energy providers. Some local councils also offer additional support, so don't overlook regional programs. By making improvements before schemes end, you can still benefit from lower installation costs and long-term energy savings. Waiting could mean paying full price later, or facing compliance penalties if new environmental regulations catch you unprepared. As 2026 approaches, making your home greener might not just be a smart move. It could soon become a legal necessity. Number 8. Non-domestic rates on short-term lets. In 2026, a major shift is taking place in how short-term lets are taxed in Scotland, and it's a trend that could soon spread across the rest of the UK. Under the new rules, many holiday lets will no longer be taxed as residential properties, but instead reclassified under non-domestic business rates. While this may sound like a technical adjustment, the financial consequences are anything but minor. This means that if you rent out your property as a short-term let, think Airbnb or similar platforms, you could be taxed as a business, with higher rates and stricter regulatory requirements. The goal is to address concerns about housing availability in popular tourist areas, where locals are being priced out by investors turning homes into year-round rentals for tourists. But for property owners, this change could make short-term letting far less profitable. Not only do you face higher tax bills, but you may also need to meet commercial property standards, maintain business insurance, and potentially register for VAT depending on your income. The days of casual short-term letting for extra cash are quickly coming to an end. If you're operating a short-term rental in Scotland, or planning one, it's crucial to reassess your business model now. Begin by reviewing whether your property still qualifies for small business rates relief, which might help offset some of the new costs. You'll also want to factor in rising compliance demands, such as licensing, safety inspections, and occupancy limits. Alternatively, switching to a long-term tenancy could simplify your tax situation and provide more stable income. The key takeaway: short-term letting is no longer a low-maintenance side hustle. With the rules becoming more complex and expensive, property owners must adapt quickly or risk being caught out by surprise costs and legal obligations. Number 9. Inheritance tax and property gifting crackdown. The rules around property gifting and inheritance tax are tightening in 2026, and homeowners planning to pass on property to loved ones need to be more cautious than ever. HMRC is ramping up its focus on gifts with reservation, a situation where someone gives away a property but continues to benefit from it, such as living in it rent-free. Even if the property was legally transferred years ago, if you're still using it without paying full market rent, it could still be counted as part of your estate for inheritance tax purposes. This crackdown could mean larger inheritance tax bills for families who assumed they were in the clear. With the average UK home now worth well over the £325,000 tax-free threshold, many estates are being pulled into the IHT net, even those that wouldn't have been affected a few years ago. Combine that with rising property prices and stagnant thresholds, and it's clear why inheritance tax is becoming a growing concern for middle-class families, not just the wealthy. Unfortunately, gifting property without expert advice can end up costing your family thousands when it matters most. To protect your assets, now is the time to review your estate plan. If you're thinking about gifting a property, make sure you understand the 7-year rule and whether you're truly giving up all benefit from the asset. Consider speaking to an estate planner or tax advisor who can help structure the transfer in a way that's both legal and tax efficient. You might also explore trusts, lifetime transfers, or joint ownership structures. The key message is simple: the rules are changing, and HMRC is watching. If you want to pass on your property without leaving your family with a surprise tax bill, planning ahead is no longer optional. It's essential. Number 10. Digital reporting of property income. Starting in 2026, landlords across the UK will face a major change in how they report rental income, thanks to the next phase of HMRC's Making Tax Digital (MTD) initiative. If you earn over £30,000 per year from property, you'll be required to keep digital records and submit quarterly income updates through approved software, replacing the traditional once-a-year tax return. This move is designed to modernize the tax system and reduce errors, but for many landlords, especially those with small portfolios, it means more admin, more deadlines, and potentially more penalties. What makes this especially challenging is that it's not just about submitting your figures digitally. You'll need to maintain accurate, up-to-date records of all your income and expenses using HMRC-compliant accounting software. Spreadsheets and handwritten notes won't be enough. And if you're not used to dealing with accounting tools, the learning curve can be steep. Mistakes in your quarterly submissions could result in fines or audits, making it crucial to get it right the first time. To stay ahead of these changes, now is the time to start digitizing your bookkeeping process. Look into cloud-based accounting platforms like Xero, QuickBooks, or FreeAgent, many of which are already compatible with MTD. It may also be worth working with an accountant who can guide you through the transition and ensure you're compliant. Even if your property income is below the threshold now, it's wise to prepare early, especially if your earnings might increase in the near future. The bottom line is this: in 2026, managing rental income will require more than a showbox of receipts. By upgrading your systems now, you'll not only avoid penalties but also gain a clearer picture of your finances, helping you make smarter property decisions moving forward. The property tax landscape in the UK is clearly shifting, and fast. Whether you're a homeowner, landlord, investor, or even someone just thinking about stepping onto the property ladder, these changes coming in 2026 are too significant to ignore. From rising council tax bills and stricter digital reporting rules to shrinking tax allowances and disappearing incentives, it's no longer enough to wait and see. The decisions you make today could directly impact your financial future for years to come. Many of these changes are being introduced quietly, with minimal media coverage, leaving countless homeowners unaware and unprepared. But by staying informed and planning ahead, you can avoid costly surprises, make smarter investment choices, and even uncover new ways to legally reduce your tax burden. This isn't just about dodging penalties. It's about protecting your hard-earned assets and making sure you're not paying more than you should. Remember, the key takeaway here is proactive planning. Don't let these new rules catch you off guard. Review your portfolio, speak to a trusted advisor, and start making adjustments when necessary. Tax laws will continue to evolve, but those who stay informed will always be a step ahead. We'd love to hear your thoughts. Which of these tax changes concerns you the most, and how are you preparing for it? Drop your experiences or questions in the comments below. If you found this video helpful, please support us by subscribing. It's just one click, but it means the world to us. We put a lot of time and research into every video so you can stay ahead. And if you want to dive deeper, check out our other videos for more smart property tips.